Origins of Money and the Development of the Modern Financial System by L. Randall Wray. From Private Property to Money, Markets, and Monetary Production. In the alternative view presented here, primitive exchanges and monies cannot lead to the development of market exchange or to the use of money, since they do not lead to the institution of private property, which is considered to be a prerequisite to the development of monetary production, that is, production for sale in markets for monetary denominated assets. Footnote 17. As Dalton notes, moneyless market exchange was not an evolutionary stage in the sense of a dominant mode of transaction preceding the arrival of monetary means of market exchange. Barter occurs very widely in past and present economic systems, but always as minor, infrequent, or emergency transactions employed for special reasons by barterers who know of alternative and more important ways of transacting. End footnote. With the establishment of private property, we at once have the elements of a money economy. The development of private alienable property is of crucial importance to the development of markets and money precisely because it destroys the collective security of tribal or command society, which allows for ceremonial exchange and redistribution. Footnote 18. Private ownership of property certainly does not imply completely unconstrained use of the property. All societies constrain individual use of property to some extent. When the rules specifying rights of acquisition or usage are expressions of kinship or political relationships, the economic component is inextricably related to the social, and we have a socio-economic practice, institution, or process. In such cases, individual initiative regarding the use private property cannot be economically important. For example, when land is acquired through kinship, right, or tribal affiliation, there can be no economically significant market in land. Polanyi's 1968 notion of commodification perhaps helps to define private property. However, because his term is so closely identified with a self-regulating market economy, it may imply that commodification of land and labor did not appear until the 19th century. I do not use the term private property so narrowly, but it should be recognized that there is a range of privateness that is of the degree to which rights of acquisition and usage are constrained by kinship and political relationships. End footnote. The introduction of private property generates existential uncertainty in which each member of society becomes responsible for his, her, including family members, own social and economic well-being. Footnote 19. By uncertainty, I mean Keynesian uncertainty, not risk. Keynes defined uncertainty as follows, quote, "By uncertain knowledge, let me explain. I do not mean merely to distinguish what is known for certain from what is only probable. The game of roulette is not subject, in this sense, to uncertainty, nor is the prospect of a victory bond being drawn. Or, again, the expectation of life is only slightly uncertain. Even the weather is only moderately uncertain. In the sense in which I am using the term is that in which the prospect of a European war is uncertain, or the price of copper and the rate of interest 20 years hence, or the obsolescence of a new invention, or the position of private wealth owners in the social system in 1970. About these matters, there is no scientific basis on which to form any calculable probability whatever. We simply do not know." End quote. End footnote. The existential uncertainty that is generated by the introduction of private property is thus a crucial element in the alternative explanation of the passage from ceremonial to market exchange. In tribal society, reciprocal and redistributive modes of social integration ensure that the material needs of any particular individual in society will be met according to the ability of the tribe to do so. This does not mean that one will never go hungry, but that there is no distinction between the economic conditions of the individual and the society as a whole. Anthropologists note that the typical case in tribal society is one of chronic underproduction. There is little attempt to produce much beyond a subsistence level, nor to hoard for unforeseen natural disasters. The attitude commonly found in tribal society is one of confidence that biological needs will be satisfied. In these societies, there is little concern for personal possessions. Indeed, personal accumulation of property is normally viewed with disdain and is made nearly impossible by the aforementioned redistribution and sharing. Similar conditions prevail in those societies based on a central authority, whether chief, king, or priest, who receives obligatory transfers and then redistributes some of this to the community. While such societies certainly are not communistic, the redistributive function tends to ensure some minimal satisfaction of material wants. Finally, within the feudal manor, one again finds a nearly self-sufficient economic unit whose redistributive process is designed to meet subsistence requirements. However, with the development of private property and land, one, usually the individual household, becomes personally responsible for meeting material wants. As productive activities become increasingly divorced from other social activities, that is, as reciprocity and redistribution come to play a very small role in economic processes, while they may still be of some importance in other social activities, Christmas gift-giving is socially important, although economically insignificant. Existential uncertainty is created because the social assurance of a minimal level of subsistence disappears. Individual insurance could then only be built up by producing and holding a margin of security in the form of excess production over minimum needs. The role of existential uncertainty can be seen in the behavior of individual landowners who are unable to meet their needs from their own personal productive efforts. Their existence thus depends on being able to borrow means of subsistence from other individuals. This is the basis of the first economic exchange, and it takes the form of a loan, in which one private producer extends physical product which he has accumulated as his margin of security to a borrower who in exchange promises to furnish his labor whenever the lender should require it in order to ensure his own survival. Thus, the earliest form of economic exchange produced forward contracts, which in the extreme took the form of debt bondage, in which the debtor initially rendered himself in the power of the creditor as a debt serf, and the creditor at any time during the credit term could call upon the debtor, even up to his extermination. When debt bondage was abolished, the creditor faced existential uncertainty during the period of the contract. Footnote 20. For example, debt bondage was abolished under Solon in Athens, approximately 600 BC. See Heinzohn and Steiger, 1984, for a discussion of this, and for an analysis of the development of private property out of the Mycenaean tribute economy. End footnote. This uncertainty was over the lender's ability to survive periods of depressed production. For running this risk, the lender required payment in the form of interest. Note that this is not risk of failure of repayment, but the risk of the lender failing to survive a change in his circumstances as a result of not having his emergency surplus available. The abolition of bondage created the conditions under which loans must include interest. These loans and interest were initially in kind, and in many cases the interest could be paid out of the natural fecundity of the loaned item. For example, the loan of a bushel of wheat today can be repaid with 2 bushels at the end of the next year. However, As the type of loans expanded and the terms of repayment became standardized, repayment would take a standard form, denominated in a unit of account, or a money of account. The first money of account was a wheat unit. Temples seem to have played a role in standardizing the unit of account. The creditor and debtor required a neutral witness to and enforcer of private contracts. In return for this service, the temple would receive a portion of the interest on loans. These in-kind fees, plus tribute paid to the temple, led to the accumulation of large stocks of grain, animals, and other goods with significant carrying costs. In order to reduce such costs, the temple encouraged the development of a standard wheat unit of account. In order to reduce such costs, the temple encouraged the development of a standardized wheat unit of account. This was also to the advantage of borrowers and lenders, for now repayment was not necessarily linked to the natural fecundity of loaned items. Thus, the original wheat money of account began to serve as the means of payment to retired debt. A cow loan is repaid with wheat. The barley grain was later substituted because of its invariable unit weight. Of course, even barley grains entail large transactions and storage costs. After temples began to act as depositories for creditors by holding for them the payments of debtors, transactions costs could be reduced by substituting stamped metal, the value of which was determined by its weight equivalent to the barley unit of account, for barley on withdrawal. Storage costs were reduced when the temple accepted the stamped metal in payment of tribute or fees for its service as witness in private contracts. In order to deal with counterfeiters, temples eventually switched to stamped precious metals. The credit money created in these private loan contracts thus eventually becomes standardized as a money of account. With the development of a money of account, and with the creation of a method for witnessing the legitimacy of private contracts and of enforcing them, credit money could finally circulate among third parties and perform those functions associated with money, including the medium of exchange function so obviously encountered in markets. Thus, credit money predates commodity money, and the unit of account function of money predates either the medium of exchange or means of payment functions. The origins of money are not to be found then in an hypothesized exchange society based on barter. Instead, money develops as a unit of account, or as the terms in which debts are written. A money of account comes into existence along with debts. Money proper in the full sense of the term can only exist in relation to a money of account. When private loans are made, the lender gives up private property in exchange for an IOU issued by the debtor, which represents a forward contract. This private contract must include an interest premium, the size of which is determined by the estimate of the existential uncertainty faced by the lender, who has given up reserves that provide security in the face of an unknowable future. Thus, all forward contracts involve, quote, wheat now for more wheat later, end quote, propositions, which are monetary propositions, with money serving as a unit of account. The distinction made above between money and assets denominated in the money of account is not so novel as it appears to be to the modern reader. I know the 1953 offered a detailed examination of the history of a concept variously termed imaginary money, ideal money, political money, moneta numeraria, money of account, or ghost money. He traces this concept from the 16th century through the 18th century. One can find similar ideas in the current century in the works of Cipolla, 1956. An imaginary money is a money of account, commonly called a pound throughout Europe, that never changes much in value. As Einodi correctly argues, and I will discuss in more detail below, this money of account grew almost spontaneously out of men's habit of keeping accounts in monetary units. As the ghost money frequently remained uncoined, it certainly could not fulfill that function of money orthodoxy takes as paramount medium of exchange. Instead, the ghost money was the unit of account, the social measure of economic value, the unit in which debts were measured, and the unit in which exchange rates of all media of exchange were calculated. For example, Einodi shows that in the 18th century, the Duchy of Milan used 51 different coins and 50 different monetary units. The value of each of these, however, was always determined relative to the livre, pound, money of account, which was not one of the coined units. If one of these coins were debased by clipping or through reduction of the amount of precious metals used in coinage, prices of commodities would rise in terms of this particular coin, but not in terms of the ghost money. This means, of course, that commodity prices, in addition to values of media of exchange, were actually denominated in terms of the livre money of account. As another example, the Bank of Amsterdam, reputed to be the prototype of the Bank of England, issued no notes and made no loans, but merely offered depositors clearinghouse payment services in terms of an imaginary national money of account. Similarly, the lira de banco was a unit of account, valued in equivalent gold weight units, created by giro banks to provide invariable terms for bank liabilities used by members of the Giro Payment Society. In spite of the frequent recognition of the common use of ghost money, previous economic historians have incorrectly viewed the money of account as a false money, or as a mirage, an illusion that prevented economic agents from perceiving reality. Einaudi flatly states imaginary money here is my thesis, is not money at all. He goes on to argue, as if coins were invented to facilitate exchange, and because a wide variety of coins were developed, it became necessary to invent an imaginary money to keep the monetary system in equilibrium by providing a monetary unit in which exchange rates could be denominated. Thus, Einaudi traces Europe's imaginary pound to a 10th century invention of Charlemagne, and attributes its creation to the longing of medieval men for the eternal, the immutable, the universal, accompanied by an abhorrence of the transitory, the mutable, and the particular. End quote. Footnote 21. As Einaudi adds, Eureka! Medieval man found monetary equilibrium in the imaginary money. End footnote. Einaudi also denies that the lira de banco was a ghost money because it had a physical representation as a bank liability. As I will argue, this story is actually very nearly the reverse of my position. Ghost money is money. Its origins are the origins of money. Thus, the money of account could not have been invented after coins. During the reign of Charlemagne, rather, we must look elsewhere for its origins, to the earlier creation of private property, and to an alternative explanation for the existence of physical representations of ghost money, an explanation that will be developed below. By distinguishing money from the various functions it performs, we may conclude that primitive, pre-private property economies did not use money. It is thus an inappropriate use of the comparative method to try to find objects that fulfill money-like functions in tribal societies, and then label these money. Rather, our understanding of the role money plays in capitalist economies enables us to use the comparative methodology to identify the contrast between economies with private property and economies based on communal reciprocal relations. The latter do not use money, although we may find objects that superficially appear to fulfill some of the functions we now associate with assets denominated in the money of account. Unlike production in, say, a tribal society, capitalist production always involves money. Footnote 22. Money and monetary production can also exist in a private property slave economy. However, the extent of the market must remain restricted. Propertyless wage earners are necessary for the full development of a market economy in which monetary production becomes the basis of the economy. End footnote. The capitalist must hire workers to produce the goods that will be sold on markets to workers and other capitalists. As production takes time, the capitalist must pay wages now before sales receipts are realized. Footnote 23. In the aggregate, sales receipts cannot be realized until wages are paid. End footnote. Furthermore, because the future is uncertain, wages are paid in money form, and sales receipts are uncertain because money wages need not be spent on any particular output, nor even on output in general. This means that the capitalist who borrows to pay the wage bill must pay interest, and the capitalist production is only undertaken on the expectation of making profits. Thus, capitalist production always involves money now for more money later. The market then is not a place of barter, but a place for earning the means of settling debts, that is, money. Markets cannot exist independently of money, much less predate it. Footnote 24. By market, I do not mean Polanyi's self-regulating free market economy. I use the term market to merely indicate that some goods are produced specifically for generalized exchange, that is, for economic trade. I do not include ritualized exchanges common in tribal society that fulfill reciprocal and redistributive functions for reasons discussed in the text. I do not view these as economic. However, I also do not mean to constrain the term market to include only exchanges in which prices are freely set through supply and demand. The normal case, as is discussed briefly in the text, is for prices to be administered. In pre-capitalist society, market prices were often set by treaty. In capitalist society, prices are administered by firms with market power. Free markets are an aberration, no matter what sort of society one is to analyze. Finally, by market system, I do not mean a system of supply and demand, or self-regulating economy. Rather, I use this term to indicate an economic system in which production for markets has become a significant economic activity of the society under analysis. Feudal society certainly had markets. However, the role of the market in feudal society was very limited, essentially to external trade and to trade in luxury items. In contrast, most production in capitalist societies and even in socialist societies is for internal trade. Thus, capitalist societies are characterized as having market systems. It is irrelevant for my purposes whether prices are free or are administered. I agree with Polanyi that free markets would be disastrous. I disagree over whether they have ever been widespread. End footnote. The hypothesized barter economy assumes that individuals organize their activities with the idea of marketing in mind before money exists. They specialize in producing commodities they do not need in order to exchange them in the market for desired commodities. But such production requires the pre-existence of private property and independence of individuals. As argued above, these are the prerequisites to the development of money as a unit of account. Furthermore, even production for hypothesized barter exchange in a private property economy involves time and uncertainty. But these are the additional prerequisites for monetary production. Thus, all of the prerequisites for a monetary economy already exist in the market economy that is supposed to be based on barter. It is conceivable that barter could have predated the use of money, even though the hypothesized barter economy displays all the conditions of a monetary economy. Is it conceivable that barter could have predated the use of money, even though the hypothesized barter economy displays all the conditions of a monetary economy? Levine, 1983, argues that the existence of a market requires diversity and variability of needs. Otherwise, one must suppose that the existing distribution of endowments, resources, ability, know-how, just happens to be such that a large portion of the population cannot produce for its own needs, but must produce for the market. Even if this can be accepted, it does not seem to generate the conditions required for an innovative, dynamic market, for production would be geared to satisfy the historically developed and given modes of consumption and structures of neediness. That is, the drive to accumulate is seriously constrained in the hypothesized barter economy. Only in an economy in which wealth is denominated in money does need become socially determined by the requirements of social accumulation. In a monetary economy, quote, individuals produce commodities which they do not need because their motivation for production is the acquisition of wealth as such, that is, making money. The separation of producer from consumer supports a system of exchange. That separation comes about because the idea of wealth in general has become a part of a way of life and mode of thinking. The penetration of the idea of wealth into consciousness makes pursuit of wealth through commodity production an intelligible goal. End quote. Levine. This separation of producer from consumer requires, for its full development, the existence of private property and the creation of a class of propertyless workers. The existence of propertyless workers also extended market demand and extended the medium of exchange function of money. In conclusion, market supply is created as production becomes oriented to the market to obtain money-denominated assets. Market demand exists because propertyless workers must purchase the means of subsistence through the use of money wages. Footnote 25. Of course, workers are not the only source of market demand, but market demand would remain restricted until a large portion of the population relies on money wages for subsistence. End footnote. The preceding discussion has admittedly flown through several thousand years, covering the whole period from the first tentative movements away from tribal society to the development of a full-blown capitalist society. On one hand, this can be justified by the argument that all pre-capital societies are much more similar with one another than any is with capitalism. The origins of money lie in the early development of private property. However, money and monetary production remained embedded in non-economic social relations until the emergence of a monetary economy relatively recently. There is no novelty in this claim. One can find similar arguments in Stanfield, 1986, in Polanyi, 1968, and in Heilbronner, 1985. Stanfield argues that the major transition to the modern economy occurred in the 17th century, during which the mercantilist state took an active role in the creation of internal markets. From this, from this point forward, the economy gradually emerged and began to shape the rules and norms of society. Stanfield, 1986. This culminated, according to Polanyi, in the conscious creation of a self-regulating free market in the 19th century, in which the disembedded economy functioned without the direction of authorities. A market myth was created, summarized as the belief that pursuit of self-gain would achieve social provisioning even without purposeful pursuit of this social purpose. According to Polanyi, the attempt at creating a self-regulating market economy failed, thus engendered a protective response to limit the functioning of markets precisely because they could not achieve social provisioning. Finally, Heilbroner argues that the creation of capitalist society represented a revolutionary movement in which an economic system is created whose overriding function is to accumulate capital rather than to ensure social provisioning. This continual expansive metamorphosis of capital is the essential logic of capitalism. Furthermore, as Keynes argued, this logic of accumulation takes the form of accumulation of greater nominal values. Clearly, capitalism, a system based on nominal accumulation, is a system very different from previous institutionalized interactions among humans and between humans and nature. However, one cannot ignore the substantial differences between tribal society, which does not use money, and pre-capitalist societies, which do. Once private property appears, we have the origins of money and the development of markets. Markets have been fairly common since the later Stone Age. Monetary production, however, remains a much later development. Footnote 26. Recall the distinction made above between a barter economy and monetary economy. As Keynes argued, a non-monetary economy may use money for transitory convenience, but most production is not for the market. Tribute economies, slave economies, and feudal economies use money. This is beyond question, but none can be characterized as monetary systems. Most production in these economies is not monetary production. End footnote. As we recognize by Polanyi, markets exist long before a system based on markets appears. While I am not convinced that anything approaching Polanyi's self-regulating free markets ever existed, this is not important for our analysis. It is clear that markets can exist in a variety of economic systems, from the tribute economies based on central authority to the democratic societies of ancient Greece, and from the Roman slave society to the feudal societies of Europe. Even though most production in all of these societies never entered markets, markets and sale of goods for money-denominated assets certainly played a role in all of them. This admission, however, concedes nothing to the neoclassical insistence on seeing a natural propensity to truck and barter in all societies. Rather, in most of these cases, markets were set up specifically by state intervention. In all cases, states regularly intervened. Indeed, Levi-Strauss defines exchange as a peaceful resolved war and likens exchange rates to peace treaties. Polanyi writes of the creation of markets by generals to provision armies. Prices were not set by the higgling and haggling of markets. Rather, quote, traditionally, trade carried no taint of commerce. In its origins, a semi-warlike occupation, it never cut loose from government associations, apart from which but little trading could take place under archaic conditions. Treaty prices were matters of negotiation, with much diplomatic haggling to precede them. Once a treaty was established, bargaining was at an end. For treaty meant a set price at which trading took its course. As there was no trade without treaty, so the existence of treaty precluded the practices of the market. End quote. Polanyi, 1971. The existence of private property, money, and markets is apparently not sufficient for the development of a market system, or, better, a system based on production for sale in markets for money-denominated assets. In Wray, 1990, it is argued that the extent of the market would remain limited until a substantial portion of the population became propertyless, thus became wage workers. Footnote 27. As David Herley notes, even in Renaissance Florence, most production was geared toward luxury items for the rich, because the purchasing power of the average European was simply not sufficient to encourage a market in common items. The Italians of the Renaissance period would seem to have had the ingenuity, the business acumen, and the capital to progress in the industrialization of production, and thus to lead their society, and perhaps all Europe, towards industrialism. But the character of the market would not readily support efforts at mechanization and mass production. End footnote. As Stanfield argues, the hungry must obtain food, but how they go about obtaining it is institutionalized. The propertyless and therefore hungry individual may rely on family, on begging, on government redistribution, or on wages by selling labor power. Polanyi's fictitious commodification of labor, each depending on the response engendered by institutional arrangements. Bloch, 1953, argues that the creation of a pool of potential wage laborers was accomplished by a process often somewhat narrowly called the enclosure movement. Footnote 28. In addition to the enclosure of common lands, a labor force was created by the Statute of Artificers, by imposing penalties for vagabondage through forcible liquidation of the clan's lands in Scotland, by seizure of church lands and expulsion of peasants, through bankruptcy of artisans by factory production, and so on. End footnote. Again, however, the labor market did not spring naturally from this development, but was gradually created, and the extent of production for market would be severely constrained until labor became commodified, a process that resulted in part from accelerated privatization of land. In summary, money first existed as a unit of account that was created after the development of private, alienable property allowed private loans. As loans came to be written in a standard money of account, the means of payment function of money developed. This gradually led to production for market to earn the means of settling debts, which generated a medium of exchange function for money. The first standardized money of account was wheat, but it was subsequently replaced by barley. Money as a unit of account would be created as part of a forward debt contract. Money acting as a medium of exchange or means of payment would take a physical form, wheat or barley, and later metals or paper IOUs, denominated in terms of the idealized money of account. Because production in a market system is always monetary production, its purpose is to realize production in money form. Thus, the purpose of production in a market economy is to accumulate money-denominated units of the social measure of wealth. Accumulation of money-denominated assets becomes the universally recognized path to wealth. The money of account becomes the social unit of value.